Okay, let me bring in our third guest, Peter Schiff, who oversees $1 billion as president of Euro-Pacific Capital. Just managed to rush in on this Friday afternoon, Peter. Listen, I was just asking our other guests, Jack Malvey as well as Mark Pato, about this announcement about Tim Geithner. We're seeing a reaction equities, not so much in the bond markets. It's partly expected. What is your reaction to this? You're a bear in the market.
Yeah, look, I think it's a short covering rally. I don't think it matters who they put as Treasury Secretary. The economy is in terrible shape, and everything the government is doing now and everything the government is likely to do when Obama takes over is going to make the situation worse.
It's going to make it worse.
Of course. Remember, we got into this mess because we borrowed and spent too much money. The solution isn't going into deeper debt to encourage Americans to spend even more money. We need a serious recession in this country, and the government needs to get out of the way and let it happen. We need higher interest rates. We need more savings. We need more production. What's happening right now in the economy, this is not the problem. This is the consequence of the problem. The problem is that for years we borrowed money that we couldn't repay. We borrowed money to consume. We ran up trillions of dollars of debt, and now we're too broke to pay it back. And we have a phony economy that's been propped up by foreign governments and foreign workers who have produced the stuff that we bought and lent us the money to buy it. We need to recreate a viable economy in this country again, and unfortunately, that comes with a lot of pain, and we have to suck it up.
Mark, Jack, you care to disagree?
I disagree with a lot, but I'll stop.
No, go ahead. That's why you're on. What do you disagree with most?
Well, I don't think that we need to do nothing. I think that would be irresponsible, because I think government policy is needed to cushion the downside here. And I think on both sides of the aisle in Washington, it would be the case that, as shown with even the Republican Bush administration, they're very aggressive and active in trying to cushion that downside. Yeah. I agree with Peter that certainly there are areas that we have been irresponsible collectively over the course of a very long period of time, but to effectively do nothing, probably not a great idea.
Yeah, because I've had Jim Rogers on my program a lot, and he sounds the same tone as you in many ways, saying that we should do nothing. The U.S. should do nothing. And is there no middle ground, though?
No. Remember, back in 2001 and 2002, I was highly critical then of the Federal Reserve and the government's attempt to mitigate that recession. Had the government done nothing back then, we would have had a worse recession, but our economy would be in much better shape today. The housing bubble, all this reckless borrowing and spending, all these bankruptcies now on Wall Street are a direct result of what the government did back then to mitigate that recession. And unfortunately, the government is now sowing the seeds with a much bigger crisis. What we're now setting up is going to be a currency crisis. It's going to be a run on the dollar. They're going to unleash hyperinflation in the United States, where consumer prices and long-term interest rates are going to go through the roof. And it's going to be much worse. Unfortunately, government policy can't help. It only makes it worse.
Well, there's a point there, Mark. I want to bring you in, of course, into this as well. But, Peter makes one point, though. We can't be bailing out every single company.
But we don't have money to bail out anybody. We're broke. We're borrowing the money from China. We're borrowing it from Saudi Arabia. We're running it off a printing press.
Okay, but Mark, I want to get your response, because obviously you disagree, right?
Yeah, absolutely. I think that this is the solution that you have to have is printing press. You got to print the dollars. I understand what you're saying. You're worried about inflation. The thing is the whole inflation of this was built up in the last decade. That's what spurred on this, using the derivatives, using the leverage. Look at it now like a dried up sponge. You got banks that are 30-to-1 levered. You could pour 20% into it and it would just soak it up. Nothing would happen. There would be no inflation. As long as you regulate and say, now you have to be 10-to-1. No more 30-to-1. No more 40-to-1. You got to be at 10-to-1. And they can add liquidity to the financial institutions, and nothing would happen. They would have to hold it in treasuries, and it wouldn't make a difference. But we have to get back down to that 10-to-1. And that's really where this is going. I completely disagree. We're not facing inflation. We're facing deflation.
We let them go down to lower ratios by letting these companies go bankrupt. That'll wipe out a lot of their debt. When you're printing money, that's the definition of inflation. And what's going to happen is the dollar's going to fall through the floor. Asset prices are still going to fall, but consumer good prices that Americans pay when they go to the supermarket, they're going to go through the roof.
All right, Peter, Mark, Jack, just hang on. We'll be back after this break. Okay, we're joined now by our roundtable. We've got Cantor Fitzgerald's Mark Pato, and with a fixed income perspective is Barclays' Jack Malvey, and Euro Pacific Capital's Peter Schiff. Now, of course, equity markets have not been the only markets that have been on the move. We've had gold, the dollar, also oil making a lot of very dramatic movements. I want to start off with gold, though, because I know, Peter, being that you're a bear in equities, you're a bull on gold. Some might say, though, that it's not going to last, particularly with some of the deflation concerns.
Well, look, we've been in a bull market in gold since 2000. We've been in a bear market in stocks since the same year. And I think in this recent correction in the price of gold, what's amazing about gold is how well it's held up relative to other commodities, relative to other currencies. You know, gold's now at a record high against the Australian dollar, the Canadian dollar, the South African rand. Gold's, gone up dramatically against oil, against industrial metals, against agricultural commodities. So I think there's been a stealth run in gold over the past few months, except when you're looking at it through the prism of the dollar, you don't see it. But this dollar rally that we've had is phony. The next major move in the dollar is going to be a collapse.
Why do you say it's phony?
Well, because I think it's just due to deleveraging. Americans are having to sell everything they own to pay off their debt, and they're selling assets at fire sale prices. They're moving into the dollar. But that's not going to last. Everything that we are doing right now is so fundamentally destructive of the value of the dollar. And I think it's going to be a crisis. The dollar is going to drop like a stone.
Jack, you think the dollar is headed lower, despite the rally we've seen on deleveraging?
Over the near term, probably gets a little bit stronger because we're not just alone in terms of having tough times. There are tough times in Europe. There are tough times coming in Asia. So in some ways, it's tough currency except for all the rest. So it's a year from now. I wouldn't be surprised if the dollar is a little bit stronger than it is today.
Yeah. But you got to look at the difference between why we have tough times and why they do. We have tough times because we're broke. Their tough times are because they loaned us money and we can't pay it back. But fundamentally, the creditor economies are in much better shape. They have sound economies. They can absorb these losses. We're broke. And when the world cuts us off, we have a major economic collapse coming because our phony service sector economy won't function anymore without foreigners lending us money and supplying us with goods.
Well, Europe hasn't really lent us that much. Parts of the Middle East, as you know, are really having a tough time right now as well. So,
yeah. Well, our biggest creditors are in Asia, of course, in China and Japan and Southeast Asia. But that's going to stop.
Well, Japan is in recession now, too.
Well, Japan is in much better shape than the United States. They're the world's biggest creditor. They have a balance of trade surplus. They have a high savings rate in Japan. Japan's in great shape. We're a mess. We're a complete disaster.
Not in the same camp.
Well, I mean, that's why I was able to predict everything that's happened for the last year or two. I don't know what you were forecasting a couple of years ago.
Mark,
well,
jump in.
The dollar actually has been in a decline for the last 6.5 years. The dollar index falling. And I think that was a concerted effort by the administration to devalue the currency to get us on a level playing field with a lot of our foreign competitors so we could bring manufacturing back. So I do think that we're going to probably go down and test those lows on the dollar index around 72. I don't know if I want to call it a collapse. That's the only problem. I don't want to go down the road of calling for disaster and an implosion of the capitalist system just to prove a point.
Not the capitalist system.
The dollar is going to be weaker.
Our country, we're not very capitalist anymore. We're more socialist. But I think the dollar index is going to hit 40 and potentially maybe even as low as 20.
Mark.
Okay. Yeah. See, I wouldn't go that far to say that.
Well, I wouldn't. I just did.
Okay, let's get beyond that. But Mark, in terms of the dollar, of course, we talk a lot about that in relation to the commodities. In terms of energy shares and oil prices, I mean, do you see how's the dollar going to affect oil going forward? Because we've seen a big drop already.
Well, as I said, I think that once we get past the end of the calendar year, I think there's a lot of pressure on the calendar year right now, pushing up the dollar, pushing down the price of crude, as a lot of these funds, these hedge funds, look to liquidate what they can, especially what's liquid, hitting oil, hitting gold. So we're going to see a rebound in gold and oil and a depreciation of the dollar in the first quarter. So I think that there's a very playable trade on a short-term basis.